Well, it's been a big week in the news, particularly in the economy and in the markets with stories all across the U.S., including right here in Michigan, having a big impact on our markets and on our economy. And as always, to talk about that, we're joined by Oakland University's Dr. Michael Greiner from their School of Business Administration. Michael, thanks for being with us.
Great to be here, Tyler. Happy St. Patrick's Day. I see you've got your green on.
Yeah, I do. It's always in my heart with me being a Michigan State Spartan. So that's why I'm wearing green. And every time I take a break over here, some piece of equipment is somehow shocking or pinching me to remind me that I did not wear green on the St. Patrick's Day. But regardless, let's talk about the green in our economy. It's kind of been there and gone, left and right, as the weeks go on because of inflation in the country. But let's begin with what's been a really big story nationally as a Silicon Valley bank experienced a significant issue this week and really went into basically a failure. And that caused a big concern for a lot of consumers in the markets. Does this mean that my bank might be susceptible to failure? How could this affect those that were invested in that bank, that had their money in that bank? So give us the overview, of the Silicon Valley Bank situation and how that really is affecting the market.
Yeah, this is a crazy time right now. And I'll tell you, for those of us who were involved in managing the whole financial crisis back in 2008, 2009, it's kind of giving us some bad memories because basically what you're seeing now is the second largest bank failure in the history of the country. And the last time we had such a big bank failure was when Washington Mutual failed back in 2008. This is a big deal. And in addition to that, we also had the third largest bank failure in the history of the country in the case of Signature Bank. So something's definitely going on right now. And what's going Go ahead.
No, please continue.
Okay, and basically what's going on right now is we have where the Fed has been increasing interest rates very quickly to address the crisis that we have with inflation. And as they've been doing that, though, the problem is a lot of these banks have a lot of their money invested in assets that are denominated with very low interest rates. So you have to remember, a bank, it's been described in some respects as like a confidence game, because what the bank does is it will take deposits from different depositors and it will turn around and basically lend most of that money out. And they'll only keep a small portion of that money on hand that they can then give to depositors back as they need to withdraw money. So there has to be a certain amount of confidence in the depositors that the money sitting in that bank will be safe there, because literally the bank doesn't have the money on hand to pay back all the depositors if all of them were to show up at the doors of the bank one day wanting all their money back. So there's this expectation. It's kind of like those. It's kind of like those gyms that only expect that a certain percentage of people who actually are members are going to show up at any given time. Same thing with banks, basically. Well, what happened with Silicon Valley Bank, and just as an aside, this is kind of ironic. You'd think, given its name and where it's based, that this would be a bank that's heavily invested in very risky investments. The reality is that could be no further from the truth. Because the reality is most of the risky investments out in Silicon Valley, there's plenty of venture capital to support. So instead, the place that this bank had invested the funds that were deposited with it were very safe investments. Things like treasuries, things like mortgages, the kinds of things that everybody thinks are very safe, long-term investments. But again, the problem is that these investments were essentially denominated at a low interest rate. I read that the average interest rate that of the investments that Silicon Valley Bank was invested in was at less than 2%. Well, that's not a problem when interest rates overall are close to zero. There's still that spread there, as they call it, which is the difference between the interest rate you're charging for lending out the money and the interest rate essentially that you're having to give out to depositors. Well, all that changes, of course, as the Fed has increased the interest rates. Now interest rates are up to nearly 5%. And in fact, on the market as a whole, you see interest rates as high as 6%. All of a sudden, the value of those bonds and investments that Silicon Valley had put their money into suddenly becomes worth less as a result of the fact that now they're not paying as much interest as literally need to be paid out to be able to get access to money. Well, what happened is word about this mismatch, what we call a liquidity mismatch, got around Silicon Valley. And as we've all heard, it's kind of a small community of venture capitalists and investors. And they all started talking to each other and saying to each other, hey, we better get our money out of there because Silicon Valley Bank is in trouble. Well, what that resulted in is what's called a run on the bank. And literally, if more people show up who want their money out of the bank than the bank has on hand, the bank is going to run out of money to give back to them, and they're going to have to close. The classic example of that a lot of people remember is in the movie "It's a Wonderful Life," where George, who manages a small bank, has to run around and get money from all his friends and relatives to basically make sure that he had enough money to give back to his depositors when the bank opened the next day. Well, unfortunately, when you're dealing with over $200 billion in assets, Silicon Valley Bank wasn't in a position to be able to go around to all their relatives and friends to get that kind of money. So the only place they can turn for that kind of money is, of course, the federal government. And so the federal government stepped in over the weekend and took over the bank and basically said that it's going to protect all the deposits. Now, this is really significant with this bank because you have to remember the deposits officially under the FDIC, the Federal Deposit Insurance Corporation, are only insured up to $250,000. So any money you put in above $250,000 is uninsured. Well, as it turns out, because of the fact that most of the depositors at this bank were these Silicon Valley high flyers and tech companies and that type of thing, and that they had things like their payroll invested there, and these venture capital firms had the money invested there that they were going to invest into potential new businesses. The As a result of that, a lot of these investments are higher than the $250,000 threshold. In fact, there's one depositor who I understand had deposited as much as $3.3 billion with a B, $3.3 billion in deposits into the bank, and that's just money that was sitting there. So obviously, Silicon Valley Bank didn't have that kind of money sitting around to be able to pay back these depositors when they wanted their money back. And these depositors got really nervous very quickly because they knew only a very, very small portion of the total amount of money that they had deposited with this bank was going to be insured by the Federal Reserve. So that's kind of what led to this run on the bank and to Silicon Valley Bank essentially going broke. Now, the good news is that Silicon Valley Bank does have a lot of assets. Silicon Valley Bank is nowhere near broke. And as a result of that, the odds are that the federal government is going to be able to manage this process where they'll be able to basically pay back all the depositors with money that Silicon Valley Bank has invested in places. Because again, they had these safe investments that they'd park their money in. They just couldn't get access to it at the time that the depositors were demanding it. So that's kind of what the federal government is stepping in and doing. But the problem is Silicon Valley Bank isn't the only bank that has invested its funds into safe investments that make it hard to get access to on a short-term basis. One of those, of course, was Signature Bank, which we talked about. Well, Signature Bank went broke, but in their case, they actually were involved in some pretty risky investments. In particular, they were backing a lot of cryptocurrency firms. Well, of course, as problems have emerged in the crypto environment, people got nervous about that bank, and there's been kind of a run on the bank there, which has resulted in them going belly up. Another bank that came under pressure was First Republic. And they're a bank that's primarily located on the east and west coasts, and they're known as the banker to the very wealthy. Billionaires and millionaires are frequently bankers there. So again, they put a lot of money in there, and a lot of these deposits are above the level that is insured by the FDIC. So as soon as there's even the sense that there could be the slightest bit of concern that those funds would be lost, there's a run on the bank. People try to get their money out of it as quickly as possible. So that's kind of the concern that we see going on right now.
Yeah, and it has ripple effects too, because in this case, the federal government, as you said, stepping in to provide some assistance, particularly to those depositors, to those who have money in that bank and are trying to get some of that money out. And then before this bank ultimately does go belly up, which it looks like it very well might. But that also affects then the markets down the line, because these companies are investing and these venture capitalists are investing through this bank and sometimes in this bank and their investments. And with that being now out the door or mostly out the door, that's going to affect those businesses down the line. So in terms of the federal government's concern on this, given there's already major economic concerns regarding inflation, could we expect to see, as we did in around 2008 during the housing crisis and those bank failures and before, that we could see government bailouts for the bank itself or even just for the depositors?
Yeah, that's a great question. And, that's, I think, the concern from what I've read that the president himself had a lot of issues with. He was obviously there back in 2008 and 2009 when the administration was dealing with the financial crisis back then. And so he has very strong memories of what they went through. And my sense is that he had real concerns about the possibility of setting up a bailout. He didn't really want to be in a position where the banks were doing better than they were prior to the financial crisis, which they essentially caused. And that really is something that kind of stuck in the craw of a lot of people, myself included, by the way. But that being said, the bailout that's being engineered for Silicon Valley Bank wiped out the investors in the bank itself. So people who were stockholders in the bank and people who were bondholders that the bank had issued, they all are getting wiped out entirely. It kind of sticks in your craw a little bit. You're right that some of the depositors, though, in this bank, some of whom really probably could have been a little more careful with their money by perhaps spreading the money around to multiple banks where they'd have ensured that their deposits would be protected up to the $250,000 level, but instead kind of put all their eggs in one basket, which is rule number one about investing. You never want to put all your eggs in one basket. Well, they did. And so the federal government felt the need to step in. Now, the part of the reason I think that the federal government felt the need to protect all these depositors' accounts, and they've said that they're protecting all of them, again, above and beyond just the $250,000, which is already guaranteed. And the reason why they're willing to do this is not because Silicon Valley Bank is so big. It's only the 16th largest bank in the country. And yes, it is a large bank, but it's nowhere near like what we saw in 2008 and 2009 when banks like JP Morgan Chase and Citibank and Bank of America were in trouble. When banks like that were in trouble, that they caused what we consider systemic risk, where literally if they fail, suddenly the whole economy freezes up because people can't access their money, as you kind of pointed to. Well, Silicon Valley Bank, the thing that really I think tipped the scales in terms of helping them out here is the fact that so many of the people who deposit money with them are people who do business in Silicon Valley. They're the venture capitalists, they're these tech firms. And the concern was that if these deposits aren't fully protected, that the tech sector would kind of freeze up. And as we've talked about, in some prior episodes, the tech sector right now is under some pressure. They've been involved in doing some layoffs. Their earnings haven't been what they've been expecting. We just saw last week a big announcement. I think 10,000 more employees being laid off from Meta, which is Facebook's parent. So they're already an industry that's under some pressure. And so this is being compared more to the bailout, for example, of GM and Chrysler back in the 2008, 2009 era, as opposed to the bailout of the big banks back during that time. And I think the expectation is, though, that because the federal government stepped in so quickly and so strongly, that this will probably put an end to this kind of going elsewhere and affecting other banks, because it sent a strong indication to depositors across the country and around the world that the government's going to be there to backstop their deposits, so they don't need to worry about taking the money out. As long as they do that, these banks are going to be okay. Because again, it's not a question of the fact that they don't have enough money on hand to cover all the deposits. It's a fact that they don't have enough money on hand today to cover all the deposits. So that's kind of what the federal government has been stepping in and doing. And it's not just here, by the way, where this is an issue. This became an issue in Europe as well, where we saw the Credit Suisse, which is one of the two large Swiss banks. They ended up requiring a bailout from essentially the Swiss central bank. and I think got an infusion of about $50 billion from them to try to keep them above water. And again, though, this is something, though, about sending a message to the markets that deposits are going to be protected, so you don't need to worry about taking your money out of the bank quickly, and that is going to then be what protects these banks from runs on the bank. I mean, it's the reason that the FDIC was created in the first place back in the 1930s. So as a result of that, hopefully they're sending a strong message and people will kind of be able to calm down. The bigger issue, though, in terms of the economy, is going to be that now the Fed and the European Central Bank and some of these other central banks are looking at it and saying, hey, you know, we've been raising interest rates very, very quickly to try to address this inflation issue. And now we've found ourselves where suddenly banks are getting in trouble as a result of that. Does this mean we need to slow down our rate increases? Well, we just got an answer to that yesterday from the European Central Bank, which actually said, no, we're going to continue to increase interest rates. They increased their interest rate up to up by another half percentage point. Next week, the Fed is meeting, and the expectation has been, given the fact that there have been some pretty strong numbers on the economy, that the Fed was going to increase the interest rates again by a half percentage point, basically increasing the speed that they've been increasing interest rates as opposed to what they'd been doing in the past. But now the question is, are they going to continue to do that? Because they, again, are going to kind of jeopardize the balance sheets of some of these banks. Now, we saw what happened in Europe, and obviously they continued to raise interest rates quickly. But you have to remember, in Europe, interest rates are at 3%. Here in the United States, they're at 4.5%. In Europe, also, the data seems to indicate that inflation is increasing, whereas here in America, inflation seems to be going down, not as quickly as we might like, but going down nonetheless. So it's going to be interesting to see the way that the Fed kind of threads the needle next week.
We're joined on today's program by Michael Greiner, an assistant professor of management at Oakland University's School of Business Administration, with us each and every week for our weekly market and economy segment on the Megacast. You can find more information on Oakland University programs at oakland.edu. And Michael, here in the state of Michigan on an economic level, the big story this week was the state passing legislation in the House regarding the so-called right-to-work law, repealing the right-to-work law that was enacted during the Snyder administration back in 2012. And this is a tough spot for lawmakers and for the working public to be in, because on the one hand, this repeal is meant to bolster the strength and the ability of unions to negotiate with employers about conditions, about certainly wages, especially in today's economy. But it also, in some cases, removing right to work will affect those that are not union workers and those that believe in being able to manage their own employment on their own. And so let's begin with just what right to work actually is, what that meant for Michigan's economy when it was enacted in 2012, and why this is such a significant move by state Democrats this week.
Sure, definitely. Well, what right to work is, it's kind of one of those things that they've got a political name for it, which really doesn't describe what it really is. Because where it originated is what unions would do is that as they negotiated deals with employers, they'd include as one of the provisions in the contract a provision that required everybody who's an employee at that employer to be a member of the union and to pay union dues. And the theory for that is that the union is going to quite a bit of effort to be able to negotiate these deals with the employer. There are costs involved in that, both in terms of research and the staff to do the negotiating, and then staff to kind of manage the contracts once they're in place. And that if employees are getting the benefit of those negotiations, and they should have to pay into it. That's the theory behind it. Well, what happened is that led to a lot of strength for unions, because it's a source essentially of revenues for unions that then they could use to bolster their own strength, as well as also help them engage in organizing other employers. And that's something then that people who are opposed to unions didn't like. Well, the first step then to addressing this was so-called right-to-work legislation. And again, it's a little bit of a misnomer, because basically what this legislation says is that unions when they negotiate these contracts that include those provisions that all employees need to be members of the union, that those provisions are no longer legally enforceable. So it basically says that these things that are fairly negotiated as part of a contract suddenly can no longer be enforced. And what the research has shown, and this is kind of interesting because the research has been quite equivocal. Part of the problem we're dealing with here is so much of the research is driven by political views, where we have on one side people who are opposed to unions claiming one thing, on the other side people who support unions claiming the other thing. And even when you try to be objective about it, it's hard to do that because so much goes into how the economy is affected. Sometimes it's tough to isolate the one effect rather than another. And that's certainly the case here in Michigan, where, yes, the economy has grown in Michigan after right to work legislation was passed, but it was also passed shortly after we had the 2008-2009 recession, so the economy was growing anyway. So what percentage of that growth can be attributed to the fact that we had right to work legislation, and what percentage of that can be attributed to the fact that that the economy was growing anyway? Well, that's one of the challenges that researchers have been trying to address. There's been some interesting research done to try to resolve this issue, and what they've done is that they've looked at areas where you've got a state border with, on one side you've got a right to work state, on the other side you've got a non-right to work state, and on that border, you've got counties on one side of the border and counties on the other side of the border. And these counties, obviously, because they're neighboring counties, will have a lot in common, with the exception of the fact that they're basically in different states and that they have these different legal regimes. So it helps isolate the effect then of right to work legislation. And what's really surprising about this research is, in fact, how little impact right to work has on the labor market. It does tend to hurt labor unions. I mean, that is pretty well established. Labor union membership tends to go down in counties where you have right to work legislation. It does have a slight, although small, still a slight effect on economic development. So you tend to have a little bit higher economic development, a little bit more economic activity in right to work states than in non-right to work states, but the effect is small. The big surprise to me, reviewing all the data, is that you really don't have much of an effect on wages. And that effect has been found repeatedly, where they've done study after study after study, and consistently they've found that wages really don't go up as a result of either right to work or non-right to work regimes. And that's kind of surprising, because the fact that the research has also shown that union membership tends to be associated with higher wages. So you'd think where there's higher union membership, you'd have higher wages. And interestingly enough, the data just doesn't show that.
On the program with us is Michael Greiner from Oakland University School of Business Administration. He's with us each and every Friday for our weekly market and economy talk on the Megacast. Michael, before we let you go, anything else we should be keeping an eye on this week? We got about a minute left.
Yeah, I think this is that really the big issue is this bank issue. I mean, this is a huge issue right now, and actually, it's something that is going to affect us locally as well. Because I just saw that, for example, Comerica Bank is having to go and try to raise funds to make sure that they have enough money available to protect their depositors. Now, I understand they're in good shape. They did have their stock value drop a little bit when word got out. But here we're talking, again, a major bank here in Michigan that is trying to deal with this interest rate issue, this liquidity mismatch. And it's really a challenge for all banks out there. Unfortunately, what we're dealing with these kind of mid-tier banks is that they're not big enough that they're carefully monitored by the Fed and by the FDIC, but they're also too big where, if they fail, then they can cause some real economic hardship. So I think that this is going to be a major issue to watch. And then leading to that, then of course next week the Fed's going to be meeting. So I'm sure next week we'll be talking about what happened at the Fed meeting when we get together to talk again.
Well, Michael, we appreciate you joining us, giving us some information, some background on some of these big stories making news right here in the state of Michigan and across the U.S. and, frankly, around the world this week.
Happy to be here. Have a great weekend.